Hello, everyone. Today we'll be looking over Amazon. Amazon is transformed from a pure e-commerce retailer to a diversified technology platform with dominant positions in cloud computing, which is their AWS, digital advertising, and subscription services, creating a powerful self-enforcing ecosystem that continues to expand its economic moat. So I'll be walking you through which aspects of Amazon's story remains compelling at current prices, which valuation metrics have changed most significantly, and which means for both existing investors and those considering entering a new position. Whether you're already invested in Amazon or evaluating it for the first time, this update analysis will help you make an informed decision about this tech giant at its current valuations. So this is the agenda for this video today, and we'll be looking over all of this. So first, before we begin, I believe we need to understand the Amazon's important segment, what makes Amazon different. So let's understand what's so special about it. So most people still think of Amazon as just an online store where you buy household and other items, but that's only part of the story. And not even most profitable part. Amazon has built what we call a flywheel, a self-enforcing cycle that keeps getting stronger over time. It starts with Prime members who get fast free shipping and exclusive content. These members shop more often and spend about twice as much as non-Prime members. This creates more traffic for third-party sellers on Amazon's marketplace, who then pay to advertise to reach these valuable customers. The advertising revenue, along with profits from AWS, their cloud business, funds even better customer experience through faster delivery and more content. And the cycle continues, making Amazon stronger with each rotation. This isn't just a business model, it's a competitive advantage extremely difficult for others to copy. Think of it like a snowball rolling downhill. It starts small, but keeps getting bigger and faster as it goes. And here's where many investors get confused about Amazon. If you look at revenue, you think Amazon is primarily an online store, and you'll be right, since retail makes us about 40% of total sales, but revenue doesn't tell the whole story. When it comes to profit, the pictures look completely different. AWS, Amazon's cloud computing business, generates only about 15% of revenue, but contributes a whopping 65% of operating profits. That's their advertising, a business that wasn't even broken out separately just a few years ago. Now it's generating 56 billion annually with margins around 30%, making it more profitable than Google's advertising business in some measures. The retail business, while essential for bringing customers to the platform, operates on much thinner margins. Think of it this way. The online store is like the front door to Amazon's house, but the real money is being made in backrooms with AWS and advertising. And connecting it all, that's Prime, with over 200 million members worldwide who keeps coming back because of convenience and benefits. Let's talk about Amazon's real moneymaker, AWS or Amazon Web Services. If AWS were a standalone company, it would be one of the most valuable tech companies in the world. In 2024, AWS generated about 108 billion in revenue. That's more than companies like Tesla or Netflix make in total. Even more impressive is AWS is growing at 19% per year while simultaneously increasing its profit margin from 22% to 37% in just 1 year. How is it profitable? AWS provides computing power that runs much of the internet from Netflix and Airbnb to major banks and government agencies. Once a company builds a system on AWS, it's very difficult and expensive to switch to another provider. It's like building your house on someone else's land. You can move, but it's complicated and risky. This switching cost creates a powerful competitive advantage. While Microsoft, Azure, and Google Cloud has gained some market share, AWS still controls about 30% of cloud market. And importantly, it's still growing in absolute terms. As more companies move to cloud, as artificial intelligence creates new computing demands, AWS is perfectly positioned to keep growing and generating massive profit for Amazon. While AWS gets most of the attention, Amazon's advertising business might be their best kept secret. In 2024, Amazon generated 56 billion from advertising. That's more than YouTube makes. What's really impressive is how fast their business is growing, 20% per year, which is faster than both Google and Meta. But here's the kicker. Amazon's ad business likely has higher profit margin than Google's, around 30% compared to Google's 25%. Why? Because Amazon has something no other platform has: actual purchase data. When you see an ad on Amazon, it's because you're already shopping and ready to buy, compared to that to Facebook or Google, where most ads are shown to people who aren't necessarily in buying mode. Amazon can charge more of their ads because of their delivering better results for advertisers. And the best? Amazon is still in its early stages. As more brands realize the power of advertising directly to shoppers who are ready to buy, Amazon's ad business will keep growing. Yet, many investors still don't fully appreciate how valuable this segment is, which means the market hasn't fully priced in this growth potential, I believe. Have you ever wondered why Amazon spends so much on Prime? Because it's not just about fast shipping. Prime is Amazon's secret weapon for customers' loyalty, I believe. Today, Amazon has over 200 Prime members worldwide. These members spend about twice as much as non-pairs customers, roughly 14,000 per year compared to 600. But the real magic is in the retention rate. Over 90% of Prime members renew their subscription each year. That's higher than most cable TV or streaming services. Why do people keep paying $139 per year? Because Prime isn't just about fast shipping anymore. It's include video streaming, inclusive content, music, gaming benefits, and even grocery discounts through Whole Foods. Once you're in Prime ecosystem, it becomes part of your daily life, and that's exactly what Amazon wants. This loyalty creates what we call network effects. More Prime members attract more third-party sellers to Amazon Marketplace, which makes the platform even more valuable, which attracts more Prime members. It's a vicious cycle that keeps Amazon growing, which makes it harder for competitors to win customers. For investors, Prime represents a stable, recurring revenue stream that funds Amazon other growth initiatives. So now let's be realistic. Amazon isn't without risks. The biggest concern right now are trade policies changes, potential regulations, and Amazon's massive investments. With new tariff being discussed, there are risks that consumer spending could slow, which could affect Amazon retail business. Governments around the world are looking more closely at big tech companies, which could lead to new rules and fines. And Amazon is spending an enormous amount, over 100 billion this year alone, on AI infrastructure, data centers. This heavy spending is temporarily reducing near-term profits as they build up capacity for future growth. AWS has even had to limit growth in some areas because they can't build data centers fast enough to meet demand. But here's the crucial part. None of these risks threaten Amazon's core business model. They're temporary challenges that Amazon has navigated before. Remember when people worried about Amazon investment in fulfillment center a decade ago? Those turned out to be brilliant moves that gave Amazon its delivery advantage. Today, investment in AI infrastructure will likely pay off in similar ways. As long-term investors, we need to distinguish between temporary headwinds and permanent damages to business. In Amazon's case, these are clearly temporary, I believe. While they are short-term challenges, Amazon has multiple powerful growth engines that will drive value for years to come. While there are short-term challenges, Amazon has multiple powerful growth engines that will drive value for years to come. First is AWS is far from finished growing, despite being a $108 billion business. AWS is still growing at 19% per year, and we expect this to continue at 16% annually through 2028 as more companies move to cloud and AI, creating new computing demands. Second, Amazon advertising business is growing even faster, 20% per year, and should continue at 17% annually. Third, Amazon's international business, which has been a drag on profits for years and finally turned a corner and now is profitable. With only a fraction of the global population as Prime members outside the US, there's massive room for growth. Fourth, Amazon is getting better at making money from its retail business through improved logistics and fulfillment centers and fulfillment efficiency. Retail margins are expanding, which will push Amazon overall operating margins from 11% to 13% by 2029. And finally, all of those massive investments in AI infrastructure, they might be reducing profits today, but they'll be positioning Amazon Amazon as the leader in next computing revolution. Think of it like planting trees. You don't get the shade right away, but in 10 to 15 years, you'll be grateful you planted them. That's what Amazon is doing with its AI investments today. And look at what they're doing right now to improve retail efficiency. Amazon just announced a $4 billion investment in rural delivery infrastructure by expanding to over 200 rural delivery stations. They're bringing prime level delivery speeds to small towns across America. This isn't just about servicing more customers. It's about creating operational efficiencies that will improve margins over time. Once complete, this network will deliver over 1 billion more packages annually while creating the kind of scale that drives down cost per delivery. That's exactly the kind of strategic investment will help push Amazon overall operating margin from 11 to 13% by 2029. Before evaluating, let's look at companies' few key metrics. So let's look at revenue chart. So revenue is important because company needs growing revenue to stay competitive and fund future innovation. Without revenue growth, a company can't sustain long-term success. Revenue is the total amount of money a company brings from selling its products or services before subtracting any costs. So as you can see, it's growing over the years and it has grown significantly. So Amazon total revenue grew to $638 billion in 2024. It's a 10% growth. But what's really interesting is that AWS Cloud Computer grew 19%. This is the business that runs Netflix, Airbnb. Advertising grew 20%. That's the business that shows your product recommendation. And retail, that's the part you see as a customer, only grew 8%. So now let's dive into Amazon valuation. So before we look at how much it should worth, let's come down and look at some of the parameters that we'll be adding. So unlike some other overly optimistic analysis you might have seen, my model uses conservative assumptions grounded in Amazon's actual performance trajectory. We carefully calibrated our discounted cash flow model with parameters that reflects current market conditions. So our risk-free rate so I'm gonna assume it at 4.2, and I'm gonna say the beta to be around 1.1. So for terminal growth rate, I'm gonna assume it to be 3. So for this one, we're gonna be using 5-year projection model. So now let's look at already input some low assumptions. So I'm gonna move to mid assumptions. So I'm gonna say it to be 9 and 11, 13, 30. I'm gonna assume this to be 22, and let's say this one's give or take 9.5% discount rate. So let's move on to high. I'm gonna assume to be, let's say, growth rate of 12. Let's do 13. Free cash flow to be, let's say, I'm gonna assume 15 for this one, and PE 32. 24, and discount rate to be 10%. So all right, so I've updated my evaluation, so let's go check it out. So here are the valuation results. So in this case, so if you believe in the lower assumptions, then the stock should worth around $162. And if you believe in mid assumptions, then this is what it should worth. And if you believe the more high, so this is what it should worth. This is the PE valuation range, and these are the based on the current stock price, I believe, which is around 230 as of recording this video. So it needs to come down to 15 if you believe in mid, or if you believe in lower or high assumptions. So and these are the the projected revenue, projected free cash flow, and growth rates and free cash flow margins. These are some of the projections in chart that it shows. So this is the sensitivity analysis. So this kind of shows you based on discount and growth rate, and depending on which assumptions that you might believe. So if you believe that if it grows at 9% with a discount rate of 9.5, this is how much it should worth. So this needs to drop this percent. Or if you believe in these assumptions, then this is what this should worth. This discounted cash flow model valuation is moderately sensitive to changes in growth rate and discount rate assumptions. So let's in 1% increase in growth rate increases DCF value by 20.8, and it decreases the discount rate to 0.06. So these are based on the input assumptions by the user, in this case me. So these are the confident range based on reasonable assumption for this company. So all of this is just my opinion, these assumptions that I inputted that I believe the stock should worth. So, and this is the projected, the average 3-year revenue growth, and this is historical 22.5 net income growth and free cash flow. So based on historical growth pattern, a reasonable growth rate assumption would be 18.2 to 33.8. The discount cash flow model is currently configured with 7 or 12%, which is conservative compared to historical performance. And if you believe all of that, the terminal value for the stock would be 2.6 trillion. So, and lastly, this is just a recommendation based on the input values that I've entered, because the fair value in this case is $161, and the current price is, I believe, to be $233, and it's telling us to avoid the stock. So yeah, it needs to come down to much lower value for us to consider an investment. Back to our main question, will I buy the stock? To basically wrap this up, let's remember what Amazon really is today. It's not just an online store. It's a cloud computing giant, an advertising powerhouse, a subscription service leader, and a logistic innovator, all wrapped into one company. At the core is AWS, generating massive profits that funds the rest of the business. Surrounding that are advertising and Prime, which creates sticky customer relationships and high margin revenue. And on the outside is the retail business, which brings in customers that make everything else possible. Yes, there will be short-term volatility. There always is with stocks. Trade policies might change, economy might slow down, and Amazon stock might dip further in the future. But if you look past these temporary concerns, the long-term story remains incredibly strong. Morningstar gives Amazon a wide economic mode rating and believes it could be worth $500 billion more in the next decade. For long-term investors who can ignore these noise and focus on fundamentals, Amazon represents one of the best opportunities in the market today. So our final advice, don't overcomplicate it. So if I believe Amazon is undervalued or comes close to my value, I will be buying it. These insights are solely my opinions and conclusions drawn from my personal research, and they should not be considered financial advice. Investing always comes with inherent risk. It's crucial to invest in areas you understand rather than speculating. Before making any investment decisions, I strongly advise conducting your own research and thorough due diligence. Thank you for watching and supporting the Research on Investments channel, and I look forward to seeing you in the next video. Bye.